Hey everyone, it is Macro Thursday, which is to say that every once in a while on Thursdays, we like to talk about macro charts, the big picture that actually really matters to stock market traders and investors. Most traders actually really don't pay attention to stuff, which is probably why they lose money. So I have two charts, you can see them in the back here, that we are going to talk about here in just a minute to give you guys some perspective. And one of these is actually a leading indicator that I think everyone should be paying attention to. It's a very simple one, but it's a good one. Also, I still have this thing on. In fact, I got word yesterday that I do have a broken wrist. For those of you guys that were asking me, thank you for all the well wishes. So I'll be having this on for a few weeks and hopefully get better sooner rather than later. Lastly, I'm moving into a new office in a few weeks. And then this video here, this whole video channel is going to become a lot more official, a lot better. We're going to have couches and sofas and screens and whatever. Let's talk about these two charts, okay? And again, I encourage everyone from a trading and investing perspective to pay attention to these kind of things. So let's have a look at this stuff. Oopsie. All right. So chart number one, which is the chart over here, okay? What this is, and the details here really don't matter. This is a long-term chart. What this is, it is vacancy, job vacancies divided by the unemployment ratio. And you can see that this fell off a cliff very sharply in about the summer of 2007. And I can tell you guys, I'll tell you my story in a minute, how I lived through this. But this is a leading indicator. You can see the stock market didn't actually start to top out until later, I think in the spring of 18 or so, or 2008 or something like that. So it was a massive leading indicator. This type of this data point, and what it is again, it just tells you how many vacancy jobs there are, and there were a lot less vacancies, excuse me, as the economy started to slow down. But if you look over here, for example, this is GDP. And GDP didn't actually top out in the financial crisis until about the summer of 2008, right? So the leading indicator that I would encourage everyone to look at is job vacancies divided by unemployment rate. Now, some of you guys might be able to access that easily on certain platforms. I don't, everyone's got a different platform. It's not that hard to come by. And of course, now this continues to ramp higher. Now, one of the questions that I always get asked is, Serge, when will these trade wars finally start to hit the economy? And what I'll tell you is that in my mind, the trade wars, if that's officially what people want to label them as, ultimately they may or may not matter, but not until the economy actually slows down. And if I look at both of these data points here, they are nowhere near slowing down. In fact, if anything, GDP is potentially ready to start climbing a little bit quicker, and then maybe at some point start peaking out. And I promised you guys, I'll tell you a quick, one more thing on this. The U.S. economy, and I always tell my clients this, the U.S. economy is much less vulnerable to political noise. This is a sensitive subject, and I don't like to talk politics, but political stuff, right? Politics. Whereas like certain European economies are like entirely related to like, this kind of political. So the US economy is much more resilient to that. So that's one thing. And now let me tell you guys a story real quick, how I saw this slowdown in 2007 happen in real time, and I actually ended up quitting my job a little bit later on that year because of that. So here's the 2007, let me quickly scale back to it. This was the summer of 2000 and I'm looking at this chart here, not where my cursor is. This was the summer of 2007, all right? And I was working at JP Morgan, and I was trading in fixed income and credit default swaps and all that kind of stuff. And what we saw happening on the desk was major fixed income deals were starting to fail right in the summer of 2000, like high yield deals, were like levered buyouts basically, were starting to fail in the summer. And a lot of sort of cracks start to happen. And I was aware of this data point because one of our clients kept talking about it, and it started to sort of free fall. So just to give you a little bit of my story, and then I ended up quitting there at some point in the autumn, late 2007. because of that, because I just didn't see any good result, any good outcome to that. And so that's a little bit of my story on that. But again, just to kind of summarize, because the subject of this video, of course, was related to trade wars, I don't think they will matter until economic data actually starts to slow down. And again, this indicator here, let me show it to you one more time. This indicator here so far isn't showing any signs of letting up, but once it does, I will get more cautious. I hope this is helpful, folks. Again, the big picture really matters, folks, for trading and investing. I'll see you guys next time. Have a great day.